Today is the last trading day of 2023, and the market has been on quite a rally lately, but I thought I'd talk about three fintech stocks, one of which was recommended by somebody who commented on my last video, so thank you for the recommendation. That recommendation was dLocal, so we'll start there. dLocal is a company that's based out of Uruguay, which is a fintech firm that helps facilitate global payments. So it allows merchants to make cross-border payments in local currencies. So they make money basically on every transaction. They charge a fee to the merchant. So an example might be Uber wants to operate in Latin America. And so they use dLocal's platform so that they can pay all of their drivers in their local currency, whatever that may be. Let's say pesos or something. They're able to pay in pesos, even though Uber would operate in dollars, let's say. So dLocal kind of facilitates the exchange. They allow for cross-border payments, and then they take a little cut. So it's a very lucrative business. They've been growing really, really well profitably, which is nice to see. It's a rare combination. But that has attracted some skeptics. So the biggest problem right now with dLocal stock is the thorn in their side known as Muddy Waters. So let me just quickly dive into Muddy Waters and what they do. They are a short seller, and they're also a research firm. So this is their website. It looks so dismal. It says, doing the work Wall Street won't. I kind of have a love-hate relationship with short sellers. I think that if you own a stock and the stock gets a short report, I think that's a good thing because somebody out there has done all the work on the bear case for you. You don't even need to look into the bear case because they have covered all the bases and more. They've made up things, I'm sure. So just keep in mind that they have the company's worst interests in mind. They want the company to fail because they will profit. But it's nice because you can see exactly the concerns that are going on with the company and you can make your own judgment from there. Just a quick word of caution. Muddy Waters' track record is not the best. Just right here in October of 2023, this past year, they released a short report on Sunrun. And you can see October 25th, when that report came out, Sunrun was trading at about $8.85. Sunrun has rallied 130% since that report. So just all I'm saying there is you shouldn't look at short-term performance and say, haha, they lost, but maybe their track record isn't the best, let's say. A lot can happen. I mean, Sunrun can still go down, but that's just my example to say maybe take that with a grain of salt. So here's their short report, their initial one. They just will not leave dLocal alone. They keep tweeting. They keep, doubling down on their short reports. So dLocal has just been kind of under fire by them. Essentially what they think is that their financials are too good to be true, and they think that must lead to cooked books. Oh man, yep, they're definitely cooking the books. Basically what happened was dLocal came back and refuted the short report very quickly. We love to see when companies address short reports and instead of sweeping them under the rug. That was good that dLocal did that. And dLocal's biggest investors did not sell out. In fact, I think one of them actually bought more shares of dLocal. So what that tells me is that dLocal's biggest shareholders who have a huge vested interest are not worried about the short report, and dLocal themselves were able to refute it. So I think that at this point, dLocal makes a pretty compelling investment. So here is their earnings results. They put together this cute little PDF for each of their earnings reports. I like that. The only thing that I don't love to see is look at this quarter over quarter revenue growth. So sure, annual revenue growth is amazing. Oh, sorry, this is TPV, total process volume. This is revenue over here. Annual revenue growth, 47% year over year. That's astounding. But then look at the previous quarter, 161 to 164. Kind of looks like growth is stalling, which when you think about it, that makes sense. The world is kind of being hit by these macroeconomic headwinds that people won't shut up about. But still, I think that's a bit concerning. So I think we need to be a bit conservative on their growth going forward. So anyway, that's dLocal. And before I show you the spreadsheet, I'll talk about the other two firms that we're going to analyze today. So the second is TOST. Good old TOST. So TOST is a company that I've owned for a long time. I invested in them purely on the purpose of I liked that I could pay my check without having to wait for my waitress at a restaurant. I thought that was the coolest thing. And I went out and I did some research and I bought shares. So that's what intrigued me about TOST. Obviously, there's a lot more to it, but they are what's called a vertical SaaS company. So a SaaS is software as a service. A horizontal SaaS means that they cater to all industries, whereas a vertical SaaS is highly specialized in one industry. Think like Viva for healthcare. Toast operates in the restaurant industry. So all of their revenue comes from restaurants, cafes, that type of thing. So they have amazing growth and a very low valuation. And the reason for that is that their margins are not good. Their gross margins just hit 20%. So what they're doing is kind of going for the volume approach, where they capture high volume, lots of payments at low margins. So kind of like when I talked about Chewy in my last video, it's a similar approach. What's going on is that their hardware section, or segment, I should say, is weighing down their margins, while their software is actually quite profitable. So what they're trying to do is improve their margins by earning more money on transactions and their SaaS model. So Toast doesn't just facilitate payments; they can also help a restaurant with their payroll, and they can kind of be involved in their online ordering. They're involved in all aspects of a restaurant. So what they're trying to do is kind of milk those customers a little bit more. But what I like to see is, look at this. This is their margins over time. So starting with 2019, they had an awful 9% margin. But look at that. It pretty much doubled the following year to 17%, then slowly climbing up 18, almost 19, and now almost 21% gross margins. So we like to see a company that is improving their margins, especially if they were kind of low to begin with. One other thing, so this is Toast's Google Finance page. You can see that they've had steady quarter-over-quarter revenue growth. So look at that. There's not been a quarter that they didn't grow revenues. And you can also see that, yes, they're not profitable, but it looks like they are kind of making some strides. In the most recent quarter, they cut their cash burn by 2/3. So that's really nice to see. The other nice thing is, look at that. They had over $1 billion in quarterly revenue, which means $4 billion in annual revenue. So that's really nice to see. They're able to capture a lot of this market share. And being a newish IPO, their balance sheet looks very nice too. They have plenty of cash. Look at that, $1 billion in cash. So they can hopefully weather the storm near term. And here's their earnings release. They're expecting revenue 1.0 to 1.03 billion. So that's kind of the same as what they just reported. So flat quarter-over-quarter revenue growth, and revenue in the range of 3.83 to 3.86 billion for the year. So they are also expecting growth to slow down. So that's kind of what we saw with dLocal. So you're going to notice that that's a recurring theme with these fintech stocks. But anyway, let's move on now to Bill. Bill, I like that. They're just called Bill. It used to be called Bill.com, Bill Holdings, but no, their company is called Bill. They're a financial process automation firm, and they help small and medium businesses, that's SMBs. They help small and medium-sized businesses to automate financial processes that might be kind of time-consuming. So things like sending out invoices, or their accounts receivable processes, or bookkeeping. And they say that they're trying to displace, believe it or not, Excel. So some of these small businesses still do their bookkeeping on a spreadsheet. So Bill is kind of serving an underserved niche there. The problem is that niche does not do well in times of economic hardship. Small and medium businesses are the ones that are hit hardest when the economy goes south. So Bill has seen that. They've lowered their guidance. So they're only quote unquote expecting 14 to 18% growth this year, as opposed to 22 to 23% that they expected previously. That's what sent their shares tumbling. We'll talk about that in a second. Another thing is that they're spending a lot of money on SG&A, which is selling, general, administrative, and that's just anything from marketing to staffing. So it makes me think that that profitability probably will not happen anytime soon. They're actually spending more than their gross profit on SG&A. So that's not great to see, but I'd like to think that once they've effectively captured enough market share, that they can reduce that pretty quickly and turn a profit. I'm not worried about them not being profitable now. I'm just trying to look into the future and say, how are they gonna become profitable when they're spending so much? So the other thing that's nice is that they recently hit a record low valuation. If you're looking at price to annualized sales, that just hit rock bottom. It was very, very steep at their IPO, and their shares just fell and fell and fell and fell. So I actually was lucky enough to nab shares in the $50 to $60 range, and they've slowly recovered, but I still think they're cheap. I think they're still very cheap. So like I said, when the economy recovers, transaction revenues will bounce back, which is the primary way that they make money, is transactions, subscriptions, and float, which is essentially where they just reinvest the money that they have that they've not paid out yet. Okay, so without further ado, let's go to the spreadsheet, I guess. I was going to look at, here's Bill's investor deck if you want to see a little bit more about what they do. So we'll just let that sit there for a second for anyone watching. And here's my spreadsheet. So it's disruptive growth stocks. Let's start with BILL since we just talked about them. BILL has a price to annualized sales of 7.3. Historically, they've had double digits for price to annualized sales. This is what they recently reported, but obviously they're guiding much lower, so take that with a grain of salt. Their score, I've made my scoring model a bit more modular, so now you can have decimals in there. What I did was I made the valuations on the margins a bit more of a sliding scale. So BILL scores well for now, but we need to keep in mind that this growth is going to fall, so their score is also going to fall. What I really love about BILL, though, is look at this gross margin. Gross margins of 82%. That's wonderful. What I don't like is SG&A to gross profit is 92%. So that's saying that if they make a profit, a gross profit of, let's say, $1 billion, they're spending $920 million on SG&A, which is paying their staff and advertising. So they really don't have a lot left over to work with. So that's just something to keep in mind about BILL, is that they really need to cut costs, but that they're at a record low valuation. And you can probably just tell by looking at their chart. Here's the 5-year chart of BILL. Look at that. Even at their IPO, they were about the same. Not the IPO. At the IPO, they were much cheaper, but they had a much lower revenue. So here, they were very expensive, had lower revenue. Now they're cheap and have higher revenues. So they've captured market share and have not been rewarded for it. So that's my thoughts on BILL, is that when the economy recovers, BILL should also recover because their primary moneymaker is transaction revenues from small and medium businesses. And we know that small and medium businesses do not do well in a recession. So when the economy recovers, small and medium businesses will recover. BILL should recover as well. So you kind of have to think ahead and hope that they cut these costs. Let's look at TOST. You can see that I've highlighted in red. TOST has the same exact problem. 104% of their gross profit is going to SG&A, and almost 50% of their gross profit is going to R&D. So TOST really needs to cut back on their spending. I know that their gross profit is low because their margins are low. So what I'm hoping will happen is that these gross margins will continue to improve, and then this will become a smaller and smaller percentage. That's my hope. But we can see that we are rewarded for this with a very low price to annualized sales of 2.4 with really nice year-over-year revenue growth. So TOST, I like their financials. I think that all they need to do is to continue to improve their gross margins, which they are doing, as we saw. And I think right now, if you wanted to buy TOST, you're getting a really nice, fast-growing company for a very low valuation. You just have to keep in mind that the reason for that is these gross margins. And I understand that not everybody who watches my channel will be familiar with some of these terms, so let me know if you want me to explain some of these concepts. Just quickly, gross margin is essentially their revenue, right? What they are paid during the year. And then the percentage of that revenue that is not the cost of revenue. So cost of revenue, it's also called cost of goods sold, is anything that it costs to make that revenue. So with the software business, it's going to be quite low because it's a software business. They're not going to have to pay a ton. It's going to be mostly, developers and that kind of thing. With a hardware company, you're going to have the costs of the hardware, which is what TOST is seeing. If you're not familiar with TOST, they make these little tablet things that waiters and waitresses can carry around, and they're really slick. They make cash registers. They make the little tap to pay things. It's kind of like Square, if you're familiar with the Square POS system. It's like that, but specifically for restaurants. But anyway, all this is to say that gross margin is essentially how profitable a company is on a very, very surface level. So of their revenues, how much are they spending to acquire those revenues? And for TOST, it's a lot right now, which makes sense because they do have that hardware component. All right. Anyway, sorry for talking your ear off. We've got one last thing, and we're going to look at dLocal, which is down here. dLocal has a lower score only because their margins aren't great, and they're a smaller company. So my system, my spreadsheet, kind of punishes smaller companies because one of the factors I rate on is revenues. So I really like to see a company with larger revenues because it's much harder to grow a large revenue number than a small revenue number. It's kind of easy to double. I mean, I say easy. I'm not a business owner, but it's more easy to double 5 million in revenue than 500 million in revenue is kind of what I'm getting at there. But we see that despite the relatively low gross margins, they also have a relatively low valuation, price to annualized sales of 8, with this amazing 46.5% quarterly revenue growth year over year. That's really nice to see in a time when the economy is not looking so hot. So I love that they're still growing really well. They have almost no R&D, which is research and development spending, and their SG&A, which was high for Toast and Bill, is actually really low for dLocal. So I think of the three, dLocal actually surprisingly looks kind of nice from just their financials. The thing you need to keep in mind is the Muddy Water short report, the uncertainty about international stocks. I mean, they're based out of Uruguay, which is not exactly a developed market. So I think you're going to have that as a risk if you're a dLocal investor. So on the thumbnail, I said the winner is between these three stocks, Bill, Toast, and dLocal. And I find it really hard to pick a winner because I feel like all three of these companies are investable right now. I think the company that makes the most compelling investment right now is Bill. And the reason I say that is because Bill is a larger company making lots of revenue and that they're not stuck in the restaurant niche like Toast. I think any of these three companies would be investable right now, and I actually own two of them. I won't tell you which ones. I'll let you guess. But I think Bill right now is the most compelling investment, just because of their broad range and the fact that they're going to have some tailwinds when the economy recovers. So what do you guys think? Do you disagree? Do you think one of the other two is a better investment? Is there something I didn't bring up? I tried to make this as short as possible, but there's so much more we could talk about with these three. So I know I missed something. But anyway, let me know what you think of this video. Please hit that like button, hit that subscribe button, and comment down below if there's another stock you want me to cover, and I'd be happy to cover it. Thanks so much and have a great day.